Okay, let's get into it here. The government shutdown may or may not be ending this week. Good things are happening in mortgage rates, and that's because of the 10-year bond. I'm showing something in here. This is the 10-year bond. Now, mortgage rates tend to run about 2.25 to 2.5% above where the 10-year bond is. As you can see here, this is the 10-year bond back in COVID times. It was way, way low. It was like almost zero, which is why mortgage rates were at 2.75 or so. And as we've seen a lot of turbulence here going through 2022, 2023, and then last week, uh, we saw some real turbulence, but we landed and we're still at up here in the upper left 3.988. That means that the 10-year bond is under 4%. That's what you call a threshold. And what that means is there's a psychology in the market when that happens. People are going to be investing more into those long-term bonds. That really gives us confidence and optimism about where mortgage rates are heading. So I live and die by that thing. I look at it every single day. We have oil at a 5-month low. A CPI comes out this Friday. It should have come out last week, but there's nobody working in that office right now. So we'll see what we get, right? Mortgage rates right now, tonight, Monday night, these are bought down. But I wanted to show you, especially to support what I'm saying, next to the bottom here, the 7-year fixed arm is at 4.875%. Now, do you have to spend some discount to get that rate? Yeah, of course. You're spending discount to get all these rates. It's called the way it is right now. But you can get into the middle fives on the 30-year fixed, the lower fives, FHA and VA. Shoot, you can get on a jumbo loan, $1.6 million loan after 20% down, 5.25 on that. So rates are improving, but jumbos are improving and ARMs are improving the way they should. ARMs should have lower rates than the 30-year fixed. They just haven't for a while. So things are normalizing. This, if we have no discount, we're still at the low sixes on the 30-year fixed and the upper fives on the FHA, VA, and the 10-year fixed arm. 10 years is a long time to have a mortgage. If I'm doing something right now, I'm getting a 10-year fixed arm. That's 1.5 economic cycles. And so you can get that thing at 5.75 right now. As we improve, we're going to see that thing break through into the fours. That's going to be a big day when you're spending a little bit of discount to get a 10-year fixed arm into the fours. And the USDA is riding along with the FHA and VA in the upper fives right now with no discount. Why is this happening? Well, that bond thing, but also inflation. This is a consumer price index since 2021. Look at it going crazy. It's an inflation gauge. You add up the most recent 12 months of all the 0.2 inflation, 0.3 inflations. The Fed says it should be 2%. That's our goal for the last 12 months. Right now, it's about 3%, but it's not going up. And there were fears that it would be going up with tariffs and other things. It's just not. We'll find out, probably get some confirming numbers on Friday. The predictions are that it's going to be right where it is right now, which means it's moderated. This is good. All right. The consumer price index is not spiking. That means there's lower inflation. That means long term bond yields typically fall and mortgage rates follow. As the 10-year goes, so goes mortgage rates. So, good day to be confident. I'm going to put my head over here. This is investment by companies in their own companies since about 2008 in billions of dollars, right? Uh, Companies growing, companies expanding, companies build a new building, hiring more people. And you can see the two downturns here since about 2008 was the Great Recession. That's that big gray line. And then the little month-long COVID recession there, where we actually had a receding economy getting smaller. Look at this right now, the most recent quarter, this almost vertical line. This is great information for the market because strong business investment means that companies are expanding. Okay, this brings both confidence and hiring, and this supports the housing market and consumer demand. This gives the Federal Reserve confidence that they can bring rates down without fear of something going wrong. So now we should have a situation where the 10-year bond and mortgage rates follow the Fed moves more closely because the inflation data is not contradictory. So, great day. So far, so good. Go get them. Thank you so much.